we've had a lot of doomsday headlines lately.
Yeah.
It seems like every other day, news outlets have some new reason why we should be terrified about this happening, that happening. We can't answer all the world's problems tonight, but there have been a couple of headlines talking about real estate and mortgage rates lately. So I'll let you go ahead and talk a bit about those.
Yeah. And for a lot of people that are, I mean, when you are opening, you could probably just see a ton of different memes out there where it's, May 1st, the world's coming to an end. You have good credit, you're going to get a bad interest rate. People with low credit are going to get the best interest rate ever. And so, when in hindsight of that, to put some, truth in what's really happening. The loan level pricing adjustments, or LLPAs, depending on how you look it up, those actually came out like mid-February. So the way that it works, it wasn't May 1st, all of this stuff was going to get, implemented.
Okay. So what's an LLPA?
So loan level pricing adjustment. And what those are is it goes into the makeup of an interest rate. And
okay. So real quick, just for everybody then.
Yep.
So an interest rate is not just one size fits all. This is like what it is. It's actually an accumulation of a bunch of different variables.
Very like over 20, but just to name a few, you're looking at your credit score. You're looking at loan to value. So how much you're putting down, you're looking at occupancy. Are you buying this as a, owner occupier? Are you buying it as an investment? Are you buying it as a second home? Is it a duplex? Is it a fourplex? Is it a condo?
So there is no the interest rate.
Correct.
That everyone talks about.
Yep.
Okay. So just wanted to be clear on that real quick. Okay. So LLPA, and what's an example of some LLPAs?
So a lot of them are kind of what I just said. You're going to see some loan level pricing adjustments for people that have investment properties, second homes, somebody who's looking at, a single family residence or up to a fourplex. And keep in mind, when we're talking about these loan level pricing adjustments, these are for conventional loans. So these aren't for your government loan programs such as VA, FHA, USDA. So when I'm talking about these loan level pricing adjustments, it's for conventional loans only. And when they implemented the change and then the news caught wind of it, it was kind of hyped up like the news likes to do, that May 1st, everything kind of was going to come to a halt for people that have, taken care of their credit and made payments on time.
Right. But did that specific, so kind of the headlines were that everyone that's been really on top of it, you've got good credit and you've paid your dues, you did what you needed to do. Like the headlines is that now you're going to be paying like 50 or however much a month to subsidize those that are not as qualified as you. So is that in reality what happened? Is that the full picture, or is that just kind of a warped version of it?
Very warped.
Okay.
And so I know I did give you a couple slides to put on. The first one that, not that one. Yeah. So the first one is going to be basically, these were the actual changes within the loan level pricing adjustments. And you're going to see the red kind of targeted around people, with that credit score of the 779 down to like the 660, or is that 680, 680 range. And those, what is showing is basically where the pricing was hit the hardest, and then given credit in the green areas to people with, lower credit scores. Now this, when you first look at it, is shocking, right? It's upsetting to a lot of people. They're like, how could you do this? I've been paying my bills on time. So what they're trying to do is give the person that has that lower credit score an opportunity. And so when you look at the loan level pricing adjustments, once the dust has settled, and that was that other chart, that shows you people. So don't go out and just tank your credit, you guys.
Yeah.
This shows you that people with those lower credit scores are still getting high loan level pricing adjustments, right?
That is brutal.
It is. And people with really good credit, they're still getting a really good deal. Yeah, there might be some pricing adjustments built into their rates, again, for conventional loans only, but you can take a peek there and see, okay, yeah, they're kind of subsidizing a little bit from those taking it and just trying to offset people with lower credit scores a little bit more, because you can see they're still getting hit pretty hard. So what does this mean? And when I look at this chart, I see opportunity, right? There's going to be opportunity in anything that we're doing. And if, in those charts that you had pulled up, you're going to see a lot of those loan level pricing adjustments are for people that are looking to put 15 or 20% down. And in what happens when you do that, you're taking away those investors' security blanket. They're no longer going to get that, mortgage insurance, or they're not going to have that mortgage insurance for very long.
Right.
So then they want to put, some loan level pricing adjustments on there to kind of help on their end. However, when you looked at that chart, it might just mean coming up with a smaller down payment. You saw that they were actually getting a better deal.
Right. So it sounds like really what this was designed to do was to discourage investing. It kind of sounds like what they were trying to do. Discourage investing, maybe second homes. Is that?
So these are also for people buying on just single family residence that they're going to own or occupy.
Right.
So a lot of it, when you look at that chart, if somebody's looking at putting 20% down, if you want to pull that one back up, if you look at somebody who's trying to put 20% down and say they're in that bracket of 740 to 759, they're better off putting 5% down. Even when you see that sweet spot of that 15 to 20%, they're actually better off putting less of a down payment. And maybe they have the 15 or 20%, and that's totally fine. Or if they have higher of a down payment, that's a win for them as well. You can see that the pricing gets better.
Yeah. So one thing you kind of mentioned before too, that's an option that I don't think a whole lot of people realize is put down like maybe this, if you're trying to play the game here, if that's something that's super important to you, maybe go and like do that 5% down. And if you have the 20% to put down, I mean, maybe just do that 5% up front, get the kickstart the thing, and then
later on
drop that extra 15% after the fact.
Yeah. And I mean, you can wait 6 months, and you can do what's called a principal reduction payment recast. And then that way you still get the interest rate that you locked in at, but then putting that chunk of money that you already had, later on.
Right.
So it's not affecting your rate at the beginning. Or if you have a larger chunk, you could see that you would have, a lot of the loan level pricing adjustments. Now, one of the other good things that did just recently come out, because there was a lot of controversy, is that they finally got away from any sort of loan level pricing adjustment for somebody who's making a over 40% down payment. So,
right.
Not everybody has that, and that's okay.
40% down. Yeah.
So if you're like, man, I have that 20%, I really want it to go to my mortgage. Then those are options. It's just a matter of, coming up with a strategy that suits that person's needs.
Gotcha. Okay.
So
I guess what would be the big takeaway for you then, if you are kind of looking at this landscape and trying to like counsel people, what would kind of be the counsel you would give them?
Well, it just depends on their situation, right? Everybody's different. It's still a really good time to buy. And a lot of people, I think they get stuck on certain things. Well, it's what's pumped out into the media as well, where we get a little bit focused on that. And it's just trying to find the opportunity that meets everybody's individual needs. So just coming up with those strategies and saying, okay, well, you want to put this amount down. Well, if we look at it this way, we're able to come up with different solutions and ideas.
Right. No.
And maybe just different ways that they haven't thought of.
Yeah, no, that's absolutely true. So one other graph I did just want to share with everybody, because I know this is something where, the headlines make it sound like this is the very first time we've ever seen an increase in interest rates, like
Yes.
guessing by what you would assume just by hearing all the headlines. But this is the 30-year mortgage rate average going all the way back to the early 70s. and it shows you, hey, the average is actually about 7.75.
Yeah.
And it has been a while since we've been really anywhere close to that average. We had the collapse back in 2000, 2008, 2009. I mean, that brought the interest rates down, and we've kind of gotten really spoiled the past couple of years with like the interest rates and what you could get.
Mm-hmm.
Like I locked in my first property at like a 2.72. So it's like, I'm probably never going to see that again.
No,
probably not.
Just take a picture of it, put it in a frame.
Yeah, exactly.
Your kids one day. I would say, when we look at those graphs, I mean, it's nice to see, because if you talk to anybody, your grandparents or parents, normally they're going to tell you also, they've never even seen rates come that close. So, I mean, rates where they are right now, it's not scary, and it's good to see that we are still under the average. And knowing that they're anticipating, later in the end of this year, going into 2024, for rates to come down. So people are going to be in a position to refinance too.
So here's I'm sure this is a question some people are interested in now. If there's talk of the interest rates coming down, would it behoove people to wait until the interest rates come down, or jump on now and refinance or do something else?
That is a question I do get often.
Okay.
And it's one of my favorite ones. So, I mean, you have to look at it both ways, right? If you're in a low inventory market that we're in right now, there are already people that are in multiple offer situations, and they're struggling to just nail down a house in the environment that we're in right now. And so for people that say, I'm going to sit on the fence and just wait until those rates come down and inventory doesn't tick up, where do you think that's going to put you? Do you think that you're going to be struggling to now? I mean, if you're struggling now to kind of land on a home, do you think you're going to be struggling more then? Because there's going to be an influx of more people looking to purchase because the rates are come down, and you're not the only one that's saying, I'm going to wait until rates come down. So now you're going to be battling so many more people for that same house. Whereas, there's that phrase out there that's going around, you're going to want to marry the home and date the rate. And that's the reason for it. Well, you purchase your house now and get in the home now. When it comes time to refinancing and there's everybody else battling for that house, you already have the house. You're just refinancing. It's easy breezy for you.
Yeah. I mean, I'll also say, it's not necessarily like an easy walk in the park right now either, just kind of depending on the price range.
Yeah.
But it is nowhere near as competitive as it was a couple of years ago. Because I can't imagine how many pre-qualification letters you generated.
Yes. And for multiple people in the same house, it'd be like,
oh no. That's painful.
Yeah. So
I only had that happen once, where I had like two buyers wanted the same house, and it was conflicting. Yeah, we did everything the right way and everyone walked away happy. But no, don't really see that ever happening. But that's just to say how few options we had at the time. And the thing is, what's really constricting the market right now, and I'm sure you're very aware of this, is we just have all the households in the US now have interest rates of like below 4%, or like 4%, like right there in that range. So at this point, even if it comes down to like 5%, still a lot of those homeowners that usually would have moved, they're not going anywhere. They're like, man, I'm not leaving this 4% interest house to go fight for something at like a 6% or 5.5 or something like that. So we're seeing a lot of those folks decide not to move. They normally would, but they're deciding to not move at this point. And that creates that shortage, which then creates a lot of competition around the houses that are currently there.
Yeah.
So, yeah.
I would say, in connection with that too, people that are maybe having to get a home because they need to move up or downsize, how much equity are they going to make in that home where it might make sense for that move, and getting that higher interest, rate house that's going to better suit their needs, because they might have built, or have a lot of equity with the way that homes have been appreciating, to actually put that towards the new home and still be in a similar boat. So it's just a matter of maybe taking that fear out for them and showing them the actual numbers.
And I'm glad that you mentioned that. So another benefit you get of locking the property in is then you get the ability to ride that appreciation as it's going up, which, I mean, it's debatable if we can call it appreciation or not, because we live in a time of inflation, and the best asset class that handles inflation the best, that keeps pace with it, is the best, is real estate. So when you see these prices just shooting up and everyone's like, this makes no sense, what's going on? It's like, it's inflation, man. I'm
Yeah.
sorry, I don't know what to tell you.
Yeah.
Like, it's not spooky economics or anything. Like, it's just basic economics. Like, inflation, it's going up, real estate's going to keep up with it.
Yep.
And yeah, I mean, those that just sit on the sidelines and wait, like, I kind of feel bad for them, because I mean, those prices are probably not going to be coming down,
Right.
because the supply and demand is just such that there's just no way. It's going to take a long time for us to get supply and demand equal again.
Yeah.
Yeah.
Yeah.